All right, welcome everyone to our next session, and we are doing another article review, and this is a newsletter post by Lyn Alden, and Lyn is basically a research analyst and investment strategy analyst, and she does these public write-ups. She does have a paid behind the wall newsletter and some portfolios that you can get access to, but this is public information, so I'm not sharing anything that is behind a paid wall. So this is public newsletter of Lyn Alden, and this is from August 2022, talking about investment cycles. So it's August 29th post. I know Lyn because of her strong affiliation and presence in the Bitcoin community, and she does have a section on Bitcoin in this newsletter, but we will jump over. We have not started talking about Bitcoin, and I think if we're going to start talking about Bitcoin, then we should probably start in properly through scratch from start rather than jumping in the middle of a post about Bitcoin. So that's why I'm not gonna touch on Bitcoin on this session. So this is basically a newsletter that talks about investment cycle, where we are in the investment cycle, what drives investment cycle. Another, she proposes her own view or way of looking at investment cycle. And this ties in very nicely with an earlier brief article that we reviewed by Jeremy Grantham on entering into the final act of SupperBubble. And this is kind of similar theme for August that seems to be being picked up by the smart people. So maybe Akil, I can start with some initial thought, and then you can pitch in there.
Sure. Yeah.
All right, let me share this first graph that she posts right at the beginning of her post. And she proposes looking at investment cycles in terms of balancing act between what she calls value stocks and growth stocks. Now, growth stocks, she means the same thing as general technology stocks that has not a lot of upfront revenue, but a lot of investment and a lot of future expected revenue. So they are rapidly expanding into their market. While value stocks, she kind of focuses more on the sense of commodity as a value stock, things that relate to infrastructure, whether they be infrastructure that are consumable, like oil and wheat and food, or non-consumable infrastructure, like bridges and highways and roads and factories. Although in some sense they're also consumable, because she talks about this sense of gradual loss or deterioration of these infrastructure. And in this first graph, she's basically giving a ratio between
Physical
Russell
assets based
1000
business.
of, that's right, physical asset, exactly. So this graph is from Y charts, and it's a Russell 1000 value total return versus Russell 1000 growth total return, and it's a ratio between them that swing between around one, going up or down, below or above one. One is when they are having equal return, and here she shows that these gray bars are the recessions that happened. So this is 1980, a little after 1980, probably 84, 83, 1990, 2003, 4, 2008, and then to 2020, minor one around COVID. And here you can see that the value total return against growth goes up and down. So ups are the red dots and downs are the green dots. And I think up are when the value stocks are taking place, and green or down is when growths are taking more of the absorption of the capital. And her basic hypothesis is very simple, that people shift between, or emotions or investment shift between these two kinds of stocks. That when people are exuberant, commodities are free flowing, available, prices are stable on commodity and hard assets or physical assets, then people start chasing growth and start putting money into it until they become overpriced, expectation become crazy, and then they crash. And when they crash, and by that time you realize the infrastructure is broken, commodities are becoming expensive because you didn't had new production come online, then you start putting money into those, and they give better return, and they start giving higher and higher return until eventually you get again at a stable supply of commodities and physical assets, and a new growth starts, and you start putting money into growth again.
Yeah.
So she has other ways of looking at it. While you collect your thought, Aki, let me show a couple of other graphs more quickly now that I have given the premise. Another way of looking at the same thing is now comparing oil as a value in a stock representative and taking NASDAQ 100 as the technology representative. And this is from 1971 to 2021. And this is just a linear plot. And the way this is plotted is that how many barrel of oils are needed to buy NASDAQ 100, right? And that basically,
Yeah. Yeah.
just a linear translation. But if you take a logarithmic conversion between the two, how many barrel of oil, what this shows is that the number of barrels of oil needed to buy Nasdaq 100 goes down as the growth stock becomes cheap, then it goes up as the growth stock becomes more expensive and the oil becomes cheap, and then goes down and goes up and goes down and goes up, following that cycle between value and growth that she was showing earlier. And then this is another way of looking at that swing by looking just at the US commodity price index. So this is just the commodities and looking at the swing of those prices as a compound annualized growth rate CAGR, but 10-year rolling, so last 10 years. So every point is the last 10 years of compound annualized growth rate, and you see that that also swings between around that 0%, going up to plus 4 plus all the way up to now. The swings are becoming bigger, 15, 16% or 12% or so, and then going down. And this is all the way from 1815 to 2021. And basically, is kind of a hypothesis is that there is a swing back and forth between ignoring the commodities and values, productions, physical asset, and loving growth, and then realizing, okay, growth overpriced and going back to commodities. Well, so Akhil, what do you
If we
think
talk
about this way
purely
of
about
looking at
commodities,
bubbles and
yeah, yeah, if we think direct purely about commodities, commodities always have their built-in cycle inside them, because commodities, for example, oil and all these like raw materials, other metals, for example, it takes a time for you to build the capacity, and when the capacity comes online, then suddenly you have too much capacity. So commodities always have this built-in cycle into them. But what she's saying is that that cycle alternates with the growth stocks cycle. So when the commodity cycle
Mm.
goes down, at that point, growth stocks are usually on the rise. So so commodities and growth, how
And
they
that is correct.
alternate
And
with each other.
she basically says that when commodities are plentiful and the commodity stocks become cheap and investment goes down, that plentiful commodity fuels growth. For a good growth, you need a lot of resources, cheap
Mm.
resources, and that what
Yeah.
fuels growth. And so as soon as a lot of commodities come online, and then continuing this discussion, she actually goes decade by decade, and quickly she says that in 1960s it was a growth era before separation of dollar from gold backing, and it was the era of Disney and Coca-Cola and Xerox as the growth stock. And then in 1970s, when the dollar became dissociated by the gold backing, gold standard, then there was a shoot up of oil initially, and there was a lot of development of resources for oil needed, and so on and so forth. So 70s and early part of 80s was value stocks were growing up, putting in money into oil and finance, and all of those hard assets made a lot of money. In the 1990s, when oil became cheap and stable, then growth started again. And 90s was that tech bubble, right? The Internet Explorer and AOL and so on and so forth, and pets.com.
Yeah.
And then the crash happened. Then in 2000, people went back to commodities and went back to the value stocks. In 2008 happened because of that crash. And in 2010, after the 2008 crash, people were again cautious, but then they started putting money into software businesses up until 2020. So 2020 is when COVID happened. But even before COVID, there was a bubble. People were already worried that the stocks, the software companies are way overpriced. So Uber was happening and the
People have been
Facebook
worried
was
about
growing.
bubbles since 2000. People have been worried about bubble in growth stocks since like 2017, 16, 17, 18, around that time. So, but of course, the Fed basically putting money into the system was the one floating the keeping all the asset prices high. So one point I want to emphasize is that when we say that commodities are in a bubble, what it means is that commodity supply is short, right? Commodity bubble means the supply of commodities short, so prices are high. So bubble means commodity prices are high. And because a person who's not educated about first, I mean, who does not know much about finance, he might think that commodity bubble means that too much commodities. That's not bubble. That's actually the bursting of commodity bubbles. So when
Mm.
commodity supply become too much, the prices crash, and that's a bursting of commodity bubble. And then when that bursts, at that point, as you mentioned, that there's an abundant supply of commodities. So basically, the growth stocks have a fuel to grow on, which is basically commodity. So it also brings us back to important question that we are basically witnessing the crash of growth stocks, and also, as you know, that recently there was oil price was quite high, so oil was going up. So commodities, like, maybe we are now shifting back to the value stock, value form of investment, or commodity basically going up.
Right. So I think that's our main conclusion towards the end is that we are the next decade, 2020 decade. So between 2022 to 2029 will be the era of the value stocks. That the growth stocks will not bounce back as early as some think. That the exuberant prices people are willing to pay for Zoom and Peloton and Uber and Twitter and all of that. That is those highs that we saw in 2021, we will probably not see them for another 10 years, is what her
Yeah,
hypothesis is. If you extrapolate what she's saying, that you're not going to see those
yeah,
peaks. I have heard people say often that you will not see it for 5 years, but it may be even longer than 5 years that you will not see the same peaks in the software companies that you saw in 2021. 2021 was really a peak, and it's not going to re-peak again until 2020, 2030 or something like that, or 2031. So continue. Actually, let me ask you one other question that came to my mind, Akhil. I have read some people said that 2008 bubble, when it bursted and market crashed, there was so much, and it was a finance bubble and real estate bubble. There was so much liquidity injected into that crash that we never let the market readjust itself, and we kind of delayed the market pressure release mechanism that a crash is. And in 2012, when Fed finally tried to back off with their quantitative easing that they started in 2008, all the way to 12, after 4 years, there was again a mini crash that happened in 2012. And after 4 months, Fed back again, and they said, okay, we're gonna not do any quantitative tightening. We'll go back to quantitative easing. And from 2012 to 2017, 18, they continued with quantitative easing in a small scale, and they continued with low interest rates. Interest rates
yeah.
remained low throughout
Mhm.
2010s. And that's why by 2017, people started getting worried that the 2008 or 9 crisis was never allowed to release that pressure that it needed to release with a low interest rate and high balance sheet.
Yeah,
Do
when
you think
bubble
that's true?
burst. Yeah, of course, when the bubble is inflated and then it bursts, the system deleverages. People go bankrupt, the debts get wiped out, and the slate gets cleaned, and then basically everything gets reset, and then the system become healthy again. But if that leverage, for example, stays in the system, and it's basically supported by, let's say, low debt, or money is freely available, and you can keep the leverage, so that resetting does not happen. And it's a politically very difficult decision for Fed and for government to basically increase the interest rate when stock market is going up. Warren Buffett used an analogy of interest rates to asset prices as gravity to the objects. Gravity, as the interest rate goes down, asset prices goes up, and the same is true, as gravity goes down, things goes up. So interest rates are kind of gravity pulling the asset prices down. So
So do you think
so
that's why Jeremy Grantham was using the term super bubble, because this bubble has been building for more than 10 years? The crash never happened, more than almost 20 years now.
he did not mention it exactly, that this is the reason for super bubble. He just said that there have been three super bubbles so far. So what's the
Did
do they
he
share
ever
common?
gave a definition of super bubble, or what why he defined the current status as a super bubble?
Uh, I have no idea what exactly. He actually
Okay,
thinks that
so
it's
actually,
a very
Lyn
rare event.
Alden touches on it. Yeah, Lyn Alden actually does touch on this in one way, but we'll come back to it, circle back to it. The Before I get to that, there is an interesting debate. Remember in Jeremy Grantham's article, we talked about near-term problems and long-term problems that he was
Yeah.
discussing. In the same
Mhm.
say, in the same style, but in a much simpler fashion, uh, Lyn Alden talks about real-world limitation, and she picks two: cheap labor and cheap energy. The cheap labor was also used by Jeremy Grantham as one of his concerns long-term. The cheap labor is
Mhm.
not easily available, but cheap energy, I don't think, I think he just kind of mentioned it as food and energy prices, but he never went into a proper detail. Let me show you two graphs
Mhm.
about cheap energy issue. This is one graph which looks at the um, the capital expense done in oil production. So these blue bars, and you can see that it peaked around 2013, and then it rapidly declined after that by 2017 or so. That they stopped putting energy into new oil production, new oil field, new gas field exploration. And at the same time, the red line is the increasing oil expense, oil need that growed. There was a dip in 2019 when the world stopped with COVID pandemic, and and then it bounced back, and now it is continuing that graph that it was doing before 2017, 2018, 2019 drop. So it has steadily grown, and there has been no expenditure for last 10 years in oil industry, and that means that the cheap energy will go away. And it also specifically talked about cheap energy that was used by China to produce everything for the world. We think about China as cheap labor, which it was. It was a very cheap labor for the world to create a lot of material resources and supplies, cars and whatever, and TVs and computers, iPhones and whatnot. But China was not only cheap labor, it was also cheap energy. They did huge hydroelectric power projects, they did huge coal power plants, and they spent a lot of energy and they captured that energy into the materials that were being produced for the world. So let me show you another beautiful graph that Lynn shows. And this is a graph of the total energy production slash utilization of the countries. And the China's in terawatt hour per
Almost
year
twice,
is twice as much as United States
twice US.
and 10 times
Mhm.
bigger than the rest of the world. If you take every other country besides United States put together, even if you add United States and everything else, you may hardly reach the China's use and production of the electricity in China. That's how much energy China captured into the devices, into the car, into the solar panels, into the metals like steel and aluminum. All those are trapped energies. You have to smelt, you have to bake, you have to produce batteries and all that. All of them were trapped energy, and this energy was cheaply offered by China. Now, labor shortages is coming in China, and energy shortages are coming in China. Lynn also talks about the same thing that Jeremy mentioned, that the water levels are going down, the dam energy production has been cut by half, which was, I think, 18% of China's energy is dam energy, hydroelectric. So they are burning more coal because they are running out of hydroelectric energy. And then, of course, the gas supplies and oil supplies will be a big need. And China does not have that energy to trap into the material that it was trapping into. And that will hit the productions and commodity supply. And then commodity constraint, as you mentioned earlier, is the commodity bubble. When you need oil and there is no oil, the price will go up. That's the commodity bubble. Every company that makes oil will become more valuable.
Mhm. That's happening, Danish. That's happening. Warren Buffett is investing very big time in oil now. Over the last, I think, 2 or 3 years, there's a company called Occidental Petroleum. He first sold them. I think it was a debt, and he has some warrants on Occident from. I'm not sure, but there was some arrangement like that. He gave them some money, and he has some right to
When?
buy more stock at certain price. I think it was probably 2 years ago, 2 or 3 years ago. Occidental Petroleum was
Hmm.
buying another oil company, and they need a lot of money, and they did not have a lot of money, so they went to Warren Buffett, and Warren Buffett said, "Okay, I will give you the money," but it was more like, I think, a debt financing from his end. with some warrants, so he
Convertible
can buy
into
some stocks in
investment.
the future also at a certain price. Yeah. So he liked that kind of a combination. On the one hand, you give debt so that you basically have interest rate, uh, which is coming in, and then you also have the future equity benefit. You get that certainty of the debt, but also the equity upside if the stock performs well. So the Occidental Petroleum, I think, dropped from somewhere around, like, I think at that was $60 down to $10, and now it is back to $60. And Warren Buffett actually have basically loaded up on Occidental, and now he's, I think, around 20% owner of that company. So Warren
20%.
Buffett has,
That's the maximum he can, right?
yeah, yeah,
Technically, legally.
yeah.
20% is maximum ownership he
No,
can
I mean,
have.
he can have more. He can have more, but then you have all sort of filing requirements. Sometimes basically, when he owns less than 10%, he can basically just show it as an investment. But as your number grows up and up and up, like number of percentage of company that you own, at some point you can basically consolidate their financial statement into yours. So you can start treating their earning as your earning and start, rather than just using it as an
And it
investment.
becomes your company, basically.
Yeah, at some
It
point, I mean, I'm
becomes a
not
part
sure
of
what
your portfolio
percentage it
company.
is.
Yeah.
Yeah, but at some percentage you can do that actually also. But
Yeah, it is amazing. So it did drop from peak of $82, 80,
yeah,
$85 down to
yeah,
$10.
yeah.
Oh my God.
There
And
was
then
a
that was the time to load up, and now it's already
there was
back
a
up to
big
68, but it will probably cross at the high
Carl
of 85
Icahn
in the
was
future,
very
right?
angry. Carl Icahn was very angry at Warren Buffett. He was actually saying that Warren Buffett took her to the cleaners. The CEO of CEO's name, I forgot her name. She was like, "Oh, he took her to the
He
cleaners."
because he bought it so
Carl
cheap.
Icahn.
That's why he was angry that Warren bought
He
it so
bought it so
cheap.
cheap. Yeah, 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 yeah. He got such a good deal from her that Carl Icahn was very, very irritated by that. Carl Icahn was also a big time investor into that company. So,
Yeah, but
but
probably at a
that's
higher price,
yeah.
at a
I
regular
bought that
price.
stock at 10, and I was out at 18, and I like, we make chief profits, but
So,
yeah, it's,
another chart I wanted to show because to be honest, that's what Lynn says that commodities like oil and other commodities will be the next decade, next, 7, 8 years. And the things that she was showing is just blew my mind. After reading her article, I was like, I need to go buy some Occidental or something. I think at 68 is still probably cheap. Probably still have another 30, 40% upside. But this is one of the articles she showed, a graph she showed. She said that this is a free cash flow in green and red. So the blue line, basically. So they were a little bit free cash positive. These are all energy producing companies, so mostly oil company, but oil and gas essentially. And then they had this big drop around 2008 crisis, and then further down because there was a lot of cheap oil available and not that much need. And then really around 2017 or so, when they stopped investing into more oil production, that's where they started becoming free cash flow positive, and now they have really peaking, huge free cash flow positive, and they're
they
still not
learned
investing
this
into
lesson
further oil
very
production.
hard way. Yeah, oil companies learned this lesson very hard way. They poured so much money into the fracking technology. They poured so much money, and the problem was that those wells, they were very short term. Normal, the
You
traditional
have to
oil
keep
well,
investing
basically,
into more
you
production.
keep investing money. So it's basically you keep on putting the money in, and then getting the oil out and selling that oil, and getting exactly the money back that you basically put it in the first place. So it's so what's the point? So that's why
Right,
it was
because the more you invest, the cheaper the oil gets, and you get no
cheaper. The oil get
return, right?
also
So
exactly supply
it's a
supply
it's a
goes
race
up.
towards negative returns.
Sure, sure. Yeah, that's exactly what it is. That's exactly what happens.
So, and then she of course talks about the labor shortages, which I've already talked in my previous discussion with you that am not fully on board with it. I think automation will happen within the next 5 years or sooner. But of course, I mean, right now in the next 2, 3 years, next 4, 5 years, if we cannot solve for automation, then we will also have huge labor shortages because, for example, China is one of the big production company of the world country, and Chinese population is aging, and they will not have it, and their youngs don't want to work because they're getting good money, and it's going to be a problem. But let's skip over that and let's jump to the next section of our discussion. So she has next portfolio update of her public portfolio, but I'm gonna skip over it. Not much interest. And then she has a Bitcoin discussion, which again I'm gonna skip over because it's an advanced level Bitcoin discussion. And if you've not had understanding of Bitcoin, it will not make any sense. So let's go to this last section, which I really, really liked. And this is about illusory wealth. So I really enjoyed reading this section because it really stabs at the heart of it. So she talks about this idea that basically when you think you're wealthy and suddenly everything becomes more expensive through inflation and devaluation of your money, then you're not wealthy anymore. That's an illusory wealth. You thought you were wealthy because there was a bubble and everything was high. Remember, I told you about a friend who said that I'm going to retire at 2 million and he hit 1.9 million last year. He was very happy and he said, okay, I got 1.9 million in my retirement account. I need just 0.1 more and then I'll retire. And now he's suddenly down 50%. And it's like, where did that money go? So he thought he was wealthy last year. And then suddenly that money evaporated, the wealth evaporated because it was a false wealth. But this is this is that illusion. So what it is, this graph is showing that if you look at the blue line is the household net worth. Net worth means their assets, their mostly it is real estate for people, but their cars and money in the bank and equity and whatever in terms of in percentage of GDP, right? So this is normalized to GDP. And how much GDP multiple of GDP is the net wealth, and this is interest rate in red. As the interest rate went up, their net worth went down because equity was more cheaper. It was not, there was no bubble. But as interest was brought down gradually, steadily since 1980s, but especially so around 2000s, and then after again 2008 when after the last crash, the net household has risen up as percentage of GDP as measured by the stock market, right? House bubble, stock bubble, everything is a bubble. And it looks like everybody's so wealthy, right? How much money the household has is as a multiple of GDP. But this is all illusory wealth. And she goes into this big discussion about how this is not a real wealth. It will evaporate overnight as the stock bubble crash, as the market crash, as the PE resets on पिछली we talked about this in the last discussion that the PEs have still not adjusted themselves. Actually, PEs are still even higher than they were last year. So if the PEs adjust and the market adjusts and then the house prices adjust, that this household wealth will just evaporate. And then let me just show you one more graph before I take your comment. This is another graph that I really, really love. And that's why I think we are in a super bubble. She basically plotted the GDP growth and then the net household worth. And then she basically plotted not just regular GDP, but GDP times four. So it's a static multiple of GDP. As the 4-time multiple of GDP grew, or you can think of GDP growing, the net household worth followed it until there was a small increase above it, and that was the bubble. And it readjusted itself, and you went back to the actual household. Everything prices, this was illusory wealth, came down. Then there was another bubble that happened around 2008, and it got readjusted, and the wealth came back down to GDP times four. And now we're here. We are at 7 times multiple of GDP right now. Normally, the net wealth of the country is 4 times the GDP. Right now, we are at 7 times GDP, and we think even GDP is a fake inflation. Even if you look at this graph there, even GDP has a blip on its growth, which is not a natural growth. So, look at the GDP here. The GDP was steadily rising and suddenly shot up. Is it a real GDP growth? And real or not, there is a 7 times increase in the net worth from 4 time increase to three orders of
No, it
magnitude
can be,
higher.
Danish. It can be just, yeah. It can be just from the stimulus checks and people spending more, right? So
No, I
GDP,
mean
one way to
people are
measure
spending
GDP is how
more,
much.
and what happens is that the houses become double in price. You bought a house for half a million, and suddenly the houses around you are selling for 1 million. You say, "Oh, my house is 1 million." You think your equity has your wealth has doubled. You are a half a millionaire and now you're a full millionaire. But that's an illusory wealth. When the house price readjusts down to that half a million plus 10,000 or 20,000, the natural phenomena, all that wealth will suddenly disappear. And that's what that's what I think is the best explanation I've seen in the super bubble. that that never in the history of US in the last 50 years that the net household worth has reached 7 times the GDP of the country. It stayed very close to
So
4 times
basically,
GDP.
yeah, so 4 times is kind of a mean around which things oscillate, and they're gonna regress back to the mean. And if it is 7 times, draw down to 4 times is 50% cut, 50% cut in the value of the
In
assets.
the net worth, and that will come from
Yeah,
both stock market but also real estate market,
real estate. Yeah,
because a lot of this net worth
yeah,
is actually captured in the real estate. People's
that is
net
true.
worth is actually their house they own, or property they own, is the money
Yeah,
they have. So really, that's what she thinks is going on. And then I think she basically closed the whole discussion by saying that right now the best strategy is to stay away from growth for a few years and stick with the hard assets. And then, of course, she's a Bitcoiner, so she counts Bitcoin as a hard asset. So, that's part of that. But she says, of course, it has to be the commodities. And even real estate is in a bubble right now. So, that may not also be
yeah,
a good place to escape.
yeah. Real estate prices are coming down a bit, but I think people have still not realized that it's very hard to shake that shake that experience off of your head over the last 6 months. Like 6 months ago, house prices are going up, and people who were just kind of expecting the house price to go up further, they are just still in that mindset. But still,
Yeah.
prices have come down a bit.
I think you talked about this, like bigger fool theory, BFT. That
Bigger,
let
bigger
me buy
photo, yeah,
a house for more money because I will sell it to another fool for even more
yeah.
value and more price. But I think there has
A
been
lot
a
of
real switch.
Yeah, a lot of the bubbles, basically, a lot of bubbles are built around this idea that you buy an asset not for what asset can produce. Ideally, what is investment? Ideal investment is that you buy something for what it is producing, right? Today, I'm talking about traditional definition of investment, right? You buy a farm, you say, well, the farm produces the wheat, and that's the value of the farm. That's how you measure the value of the farm. Uh, but in bubble, what happens is that you buy the farm not because for what it produced, but you buy the farm because prices are going up, and 6 months later, I can sell the farm at double the price. So that's a completely different mindset. Like you are focusing on the price part, only on the price part. You're just using one parameter to make the decision, which is the price is going up. That's it. That's all you're using. So
Right. If I explain it in a or think about it in a different term, is that if you measure the value of a farm in the bushel it produced, that never changed. If it was producing 1,000 bushel a year before, it's still producing 1,000, maybe 1,005, 1,010 if you have updated your
sure.
technology or more fertilizer. So the only increase in the value of that farm is the technological increase in the bushel production. The dollar amount
Sure.
you paid for it or somebody else is going to pay for it is just a made up number.
Yeah, this
And
is a made up
that's
number.
where,
That is absolutely
yeah.
true. It's absolutely true. The value of the bushel also can fluctuate in the market. I'm talking about the price part of it. The price can vary also based on the other bushels, right? Unless your bushel is so special that it's a brand, and you say your bushel is special bushel, right? And people go to the market and buy your special bushel. If that's not the case, then basically the supply from the other uh, farms also matter.
But
So
even that, Akil, even that aspect has been completely tainted by the market, by all of these future trading and kind of betting on more or less bushel this year because of the weather or because of the rain. If you look at the bushel's value in terms of the number of people it feed, that also remains steady. If a
that's
thousand
steady.
bushel is able to feed 10,000 people, and if you count the price as that, then the price is always the same. The number of
Yeah,
each bushel is the same price, same value because of the actual value it gives, which is
the
feeding
real
someone,
value,
right?
Danish, this is the real value. But then economy is built around symbolic values, not the real values, right?
And
The
that's where all
symbolic,
these future markets and all those come in, where you are starting to bet on it that my bushel will be more expensive because there will be less number of bushels in the world. And there will be
exactly.
a Ukraine war and there will be less bushel, and suddenly my bushel becomes more valuable because there's less commodity and more people chasing.
Yeah.
And
And
this
valuable
kind of
also, valuable in the sense of symbolic currency. I can get more
in terms
symbolic
of dollar
currency
amount.
for the bushel, not valuable in the sense that my bushel can feed 100 people more than other people's bushel because my bushel is somehow special and they have more, I don't know, calories in it. That's not the case. So in the real sense, if you measure value about how much a person is being fed one bushel, how many people can feed, that of course is always the same. That's not going to change.
Exactly.
But by the way,
And
this is
that's a
just a side
tragedy
note.
because
As a
uh,
side note, this is just kind of a side piece of information. The on the average, not ice, sorry, rice. An acre of rice produces 3 times more calories than an acre of wheat. That's why
hmm,
they say that rice producing countries have very high populations. Countries who
they
eat
can feed
rice, they
more
have high
people.
population because one, they can feed more people. So that's kind of a
Hmm.
side
Uh,
information.
no, this is good observation, and I was gonna say that the whole switching the measurement of the farm and bushel by this dollar, which is a made up stuff. What it does is that disallocation of the actual real value then gives too much power to the persons who can manipulate that dollar. People who can
Sure,
play on the futures and bet
of
and win
course.
large bets, and they can then modify the whole prices of it and access of this and equal distribution, and then those capital people become resource allocator. So capital is a way of
Sure.
figuring out, okay, where should more human resource and labor should go, and they start controlling it, right? And that
Oh,
creates a
capital
huge
always
problem.
control.
Exactly.
Yeah,
And
the
that's
capital
that's one
capital
of the
controls
challenge.
things. Yeah, the main point is that the farther you are from actual work, the more power you're gonna have. That's kind of a rule of life. People who actually do work have the least amount of power. People who manage them have more power. People who manage those managers have even more power. And the person who's a politician who basically set the rules have the most power. So that's how it is. It's very uh, unfair. So, I don't know if unfair or not. That's the right word or not. But that's how life is. Uh, we will actually do the
Right.
work.
But but see, one of the debates that again, I'm touching on Bitcoin here a little bit, but one of the debates in the Bitcoin world is that this exploitation became a lot more easier once you were able to separate out the actual physical hard asset from the currency. Currency used to be what gold do you hold in your purse or in your hand, or silver coins or copper or whatever. But then it became gold certificates, then it became IOUs, then it became double book accounting, double bookkeeping, double entry bookkeeping, and so on and so forth. And it became a ledger, in a ledger based money has
Mhm.
been since the Dutch world, when the double bookkeeping started in Italy, and since then a lot of the actual physical trade of the gold and art was slowly phased out. And initially, there was at least a keeping up of appearances that we are tying it to something in reserve, although the audit of reserve was always fishy. You were never sure that the amount of issued credit against a physical asset in your bank, do you even have that much physical gold or not? And then by 1971, we know that US owed to other countries 4 or 5 times more than the gold it actually had. And it kept issuing credit to other countries where it had no gold, amount of gold. And it stopped basically giving back that gold. I mean, it stopped giving gold back to its own people in 1935 or 32, when it says, okay, now other countries can claim the gold back again for the dollar, but my own, the U.S. citizens cannot. So even before 1971, U.S. citizens lost the right to claim the gold back for the dollar, but other countries had that claim. And in 1968 and 67, 68, France started claiming the gold back, realizing that U.S. doesn't have enough gold for all the dollar it has issued. And so it called US bluff. And then by 68, 69 it became a big problem. And then finally it had to decide that we have to stop giving that claim back. But anyways, it's a long discussion separately. But I brought it up is the reason that the part of the appeal of Bitcoin is to stop that exploitation in a digital world. The reason gold was exploitable because of the physical constraint it gave in a large volume. So if you have 100 million in gold, How are you going to transfer it back and forth and back and forth and back and forth? And that difficulty allowed exploitation to happen because certificates were so much more easier to issue
So,
against it rather than keep moving the gold.
Danish, all solutions have a, built-in problems in them. People who are selling you solutions always emphasize the positive part of it, and they always ignore the negative part of it. It's like a salesman. Salesman is always telling you about
That
the
that
value and
that,
never
that
talk.
part is true, but you always ask yourself, okay, what's the best currently available solution? Normally, the negatives of a problem needs a technological breakthrough to solve them. The negative aspect of any problem. Right back then, when gold had its negative physical attributes, there was no easy solution except for this Bretton Woods system, where countries basically sit down and come up with an agreed principle of credit generation. And that was the best solution possible in the 1930s
Now, think of this in
when
this
the
way,
Bretton Woods
Danish.
Agreement happened.
Think of this. The one thing basically which people who against gold standard, they say that gold was a constraint on the growth, right? If economy is growing and gold is not growing proportionately, then the, the gold has to grow proportionately, and otherwise your bar of gold become more and more valuable and can buy more and more purchasing power. And basically people who have gold basically will end up having more and more corresponding assets. You can buy more and more assets with the gold. So to keep things on a, they want to expand the supply, they want to expand the currency with the expansion of the economy. That's what their goal was. uh,
But Akhil,
the
we
point
if
basically is,
we
let me say one thing. The thing is that in a gold based system, people who have gold will have power, right? In a in a fiat currency system, people who
people
can
who can
issue
issue
fiat
fiat.
currency, we will have power, which will be politicians and bankers, right? So in a fiat-based system, politicians and bankers will have power. In a gold-based system, traders and rich families probably will have power. So the question basically is
But
usually,
there is a difference, Akhil. So let me highlight that, which we don't think about. The In a gold-based system, people, let's say government owned gold. Let's say it's the same people who own money regardless. In a gold-based system, it's the government or politicians who owns the gold, and in a fiat system, it's the government who owns the authority to issue more fiat, so they hold the power. But there is a difference. In a gold-based system, if you need to decide to go do something big, like go on a war, then you need to go for Rothschild to borrow the gold needed. You can't just suddenly produce more gold and say, I'm going to issue more gold and I'm going to certainly have the money needed to put a war, to make a fight or create something disastrous. You are restrained by the gold you own. Within that restraint, you can do a lot, but there is a restraint. There is a
of
cap on what
course,
you can do,
of
and
course.
you can have to go to Rothschild or issue war bonds or something, and that is a voting principle. So if you issue war bonds and nobody wants to buy your war bonds, you cannot go into war.
Mhm.
And that were the limitations why they dissociated it. In a fiat system, now you not only have the authority, but you have no cap anymore. The gold
You
was the
know
cap on you.
the
Your available accumulated gold was your constraint. And
you know
once you
what
took that away into a fiat system, you got rid of the constraint.
you know what Rothschild's mother, Nathan Rothschild's mother, said once. She said that France will not go to war because my sons will not finance it. That's what I think her name was Guttel or something like that. That was her name, and she said
Yeah,
something like,
and the way they were financing it, they were helping float the war bonds of Britain, and they were backing it with their credibility and trust that this will go up because they can manipulate the market. Everybody knew they can make anything go up, and they were issuing it. If the Britain was issuing it on its own, and they tried it before going to Rothschild, nobody was buying their war bond. So Britain issued war bonds, and nobody was buying it. Okay,
mm,
against Napoleon when they were trying to do war because chances of winning of Britain was low. Napoleon was, more favored. So nobody was buying Britain's war bond. Now they're gonna lose. And then they went to Rothschild. Rothschild got them a big float, I think, equivalent to current money of $300 million or something. They floated them successfully at a certain terms that they set, at a certain cut that they got, and that's how Britain had the money to go against Napoleon. Otherwise, they had no money. And they were also financing Napoleon, by the way. They were also supplying,
Oh
credit
yeah,
and gold and
it's
war
very
bonds to them.
fascinating. No, the terms of those bonds are very interesting. That those you sell bond, you basically raise money for both parties with the terms that whoever wins will pay the debt of both parties. So you can never lose. Those were the terms.
Yeah.
And by the way, Rothschild is basically the real word is Rothschild. Roth is red in German and shield is shield. So they used to have red colored shield on their door, and from
Hmm.
that it's a Rothschild. So
Right.
yeah, that's
And ghetto was the name of the neighborhood where they all used to live in Germany. I think it was Frankfurt.